Hey traders, welcome to lesson one of the Seneca Trading Academy. We have an exciting journey ahead with lots to learn, but we can't really go forward without looking back and seeing how we got to where we are today. So the first lesson is all about the evolution of price structure analysis. It's a brief journey through the history of technical analysis, but in a way it's also a journey through my evolution of technical analysis, because this is the path I followed. I started learning from the very beginnings of where technical analysis started, and my understanding of the subject evolved through the different mentors and authors and teachers that I had in my 8-year journey. So starting at the very beginning, we go back to the Dutch financial markets in the 17th century. You'll see that some aspects of technical analysis began to appear in Amsterdam-based merchant Joseph de la Vega's accounts of these Dutch financial markets. And he recognized patterns in his accounts and wrote the book Confusion of Confusions, the oldest book ever written on the stock exchange business. And then we jump across to Asia, where technical analysis is said to be a method developed by Homer Munehisa, a rice merchant from Sakata, Japan, who traded in the Dojima rice market in Osaka during the Tokugawa shogunate. The Tokugawa shogunate is basically a period in Japanese history. He is sometimes considered to be the father of candlestick charts. And in 1755, he wrote The Fountain of Gold, the Three-Monkey Record of Money, the first book on market psychology. In this, he claims that the psychological aspect of the markets is critical to trading success, and that traders' emotions have a significant influence on rice prices. And from these two branches of history comes an important fact regarding technical analysis. And that is that what you see on price charts is nothing more than a graphical representation of market psychology. There are very few things more consistent and more predictable than human nature, and that is why we continue to see these recurring price patterns on price charts. So whenever you see a big run-up in price, a corrective structure, and either continuation or a dump of price, you know all we are seeing is a representation of market psychology. So as you can see, we go from Joseph de la Vega in the 17th century, we move into Homer Munehisa in the 18th century, and in the 19th century, it really starts to gain traction in earnest through Charles Dao and the Dao Theory. So Dao Theory has 6 basic principles, which I believe you can consider the first principles of technical analysis. And it's always good to think about things from first principles. So when we say first principles, what I mean is these principles can be found in all forms of technical analysis. They are true in all forms. No matter how you're looking at price charts, you will see these 6 components within those charts. So the first principle of Dao Theory is that the market has 3 movements. The main movement, which is kind of 1+ years, the medium swing, which is 10 days to 3 months, and the short swing, which is hours to days. And basically, this is just the different time frames that we use in our trading and or investing. So you have the main movement, which is the long-term trend, which is basically the realm of investors. Investors are looking for the long-term trend, looking to take advantage of that trend. The medium swing is where the swing traders operate. You're talking about trading within that long-term trend in a kind of 10-day to 3-month time frame. And then you have the short swing, which is hours to days, which is the realm of the day traders. Day traders are looking to take advantage of these really short-term swings in market price action. And what I like about price structure analysis is that it can be used across all 3 of these time frames, which we'll start to see when we look at the fractal nature of price structure. The second principle is that market trends have 3 phases. The first phase is accumulation distribution, which is basically insiders buying or selling their markets. We then move into the second phase, which is the public participation phase, and that's where we start to see rampant speculation by the public, and that rampant speculation starts to drive prices up or down. So the insiders get in and they start to share that information with the public, and it's the public that drives these prices up or down. Then the third phase, which is the distribution or accumulation phase, basically the opposite of the first phase, insiders start to take profits on their trades and they buy back or sell to the public who are caught up in this big speculation. When they see prices driving wildly, they want to get in. And as most rookie traders do, they get in at the top as the insiders are selling out of their position and taking their profits. The third phase is the stock market discounts all news. This is part of the efficient market hypothesis, which basically states that asset prices reflect all available information, which is something I don't really agree with in a sense, but it depends where you're getting your news from and where you are understanding your asset prices from. If you're getting your asset prices from something like the major news networks, you know that this is actually true, where all available information is available. So when news hits the market that Pfizer is releasing their new vaccine, insiders have already bought long before that news gets released. As you can see, the efficient market hypothesis and the three phases of the market trends kind of interlink, because insiders are going to be buying and selling long before all the news is available to the market. So when you hear news, like I said, that Pfizer is buying up, or that Pfizer has released a new vaccine, or Apple is releasing a revolutionary new iPhone, insiders are already in that trade. And that is the news that is reflecting on the public to get prices to move to a point where insiders will take their profits out. So yes, efficient market hypothesis is true to an extent, but through price structure analysis, we can see exactly where insiders are buying and selling and where we want to be in and out of these trades. The fourth principle is that stock market averages must confirm each other. So in short, what this means is that all markets are linked in some way, and price action of one market must confirm price action of another. And this is what's called global macro analysis. So when we analyze a chart, say the Aussie dollar yen, to see where price action is going, we also want to cross-check that with something like the S&P, because the Aussie dollar yen is a big indication of the risk on or risk off trade. If the Aussie dollar yen is surging, we would expect a big risk on trade. We'd expect things like the S&P to be rallying hard. So we do this kind of cross combination of market analysis to confirm that what we're seeing on one chart is true on other charts. The fifth principle is that trends are confirmed by volume. Basically what that means is when price moves are accompanied by high volume, we see that the trend is true. And that's what Dao believes too. And I believe that to be true as well. If you see price rallying strongly, but volume is starting to decline, you're starting to see a decrease in participation from the public. And you're also starting to see where those insiders have sold a lot of their stock. And we're starting to see the top, or the potential top of a trend. And price structure analysis, once again, really helps us to see those areas where we expect that to occur. And finally, the sixth principle of Dao theory states that trends exist until definitive signals prove that they have ended. Dao believed that trends existed despite market noise, and markets might temporarily move in the direction opposite to the trend, but they will soon resume the prior move. The trend should be given the benefit of the doubt during these reversals. And how this relates to price structure analysis is basically back to the first principle and the different movements of the market. We want to look at the longer term trend and see, are we trading against that trend or are we trading with that trend? And that's going to play a big part in our trading strategy. So from Charles Dao's Dao theory, we basically have a split in how we start to analyze charts, and it starts to be more refined, where we move either into Richard Scharbacher's technical analysis and stock market profits, which is basically the road of classical charting, or we move into Ralph Nelson Elliott's the wave principle, which is Elliott wave theory as it's known today. So in the 20s and 30s, Richard Scharbacher published several books which continued the work of Charles Dao and William Peter Hamilton, which we just discussed as Dao theory. His most popular being Technical Analysis and Stock Market Profits, which is widely recognized by many as the Bible of classical charting. And on the other hand, we had around the same time Ralph Nelson Elliott's study of the stock market data, which led him to develop what's called wave principle, a form of technical analysis that identifies trends in financial markets. So in August 1938, he detailed the result of 8 years of studying price charts by publishing his third book entitled The Wave Principle. So basically, Elliott spent 8 years studying price charts from the weekly or monthly or even yearly charts all the way down to the 15-minute or 30-minute charts, and he came up with what he called the wave principle. And in this, he proposed that market prices unfold in specific patterns which practitioners today call Elliott waves. He stated that while stock market prices may appear random and unpredictable, they actually follow predictable natural laws and can be measured and forecast using Fibonacci numbers. What most people get wrong today is that they use Fibonacci retracements, which we get to in the 4th lesson of part 1. We say, in which we just show you how Fibonacci retracements are a very inaccurate form of analysis and how we actually use Fibonacci numbers in a much more accurate manner. So here we see a kind of graphical representation of those two branches where we have classical charting, which is basically all about classical charting patterns. Head and shoulders, your pennants, things along those lines, which we get to in the next section. And then we have Elliott wave theory, which is all about your impulses and corrections, which we get to in part 3 of this section. Those kind of founding branches evolved on their own too, where you start to see things like Edwards and McGee, which is another major book that came out, and another one that is considered the Bible, which is called Technical Analysis of Stock Trends. Interestingly enough, Edwards was the brother-in-law of Richard Scharbacher, so they just furthered what they saw from Scharbacher. And then you had guys like Frost and Prechter, which kind of furthered on Elliott's work. And later on, you had someone like Glenn Neely, who took a deep dive into Elliott's principles and furthered those principles in his book called Mastering Elliott Wave, which is also a highly technical book, but something that price structure analysis draws heavily from. And that's where we get to price structure analysis, which basically it's rooted firmly in Elliott Wave, but also draws on classical charting concepts and the principles of Dao Theory, as I stated. So we basically bring together the best of classical charting patterns, the best of Elliott Wave. We amalgamate that into price structure analysis, which is fast gaining traction as the most accurate and reliable analysis in the markets today. So that's where we got to where we are now. And moving forward, we'll show you a more detailed version of that trip. We'll get into kind of the basics of classical chart patterns, get into the basics of Elliott Wave, and then we'll move into how we combine that into price structure analysis and why it is so effective. So the next lesson is all about classical chart patterns and how we use chart patterns to get a good grasp of our analysis. So we'll see you then.